we're wired by God to look for the shortest path, to look for optimum, to look for the best, the quickest, the easiest. And there's nothing wrong with that. That makes our lives better because we create inventions and things that make our lives better. That very wiring created the automobile or created the iPhone or created, things that make our lives better. And so that's a good wiring. But where it gets off track is where we think we can short circuit a proven process. And it causes you to jump from investor to speculator. An investor is always the crockpot. They're always the long play. They're always saying, okay, I'm going to invest in mutual funds. I don't care what the stock market did this year. I'm thinking, what's it going to be in 20 years? What's it going to be in 15 years? And how am I going to be doing? And so I'm thinking long term. The speculator needs a quick flip. And so Bitcoin has never really been about investing. It's a speculation. It's a short-term play. No one bought that and said, in 20 years, this is going to look brilliant. They all thought quick money, easy money. No one flips houses with nothing down that they saw on TikTok, quick flip. When a builder even builds a home that they're not custom building, they call it a spec house. It means speculation, speculating that they're going to sell that house. It's a short-term play. They're not building that house in that subdivision hoping to sit on it 10 years. They're building it hoping to sit on it 10 days. And so it's speculation. So where you get confused, where you mess up is where you can fall into scams and get rich quick and violate basic investing principles is when you move from investing, which is long-term mentality, to speculation, which is quick hit. I want quick money, quick money, easy money. And that's that wiring, that's positive wiring gone astray. And I've owned like 2,000 houses in my life. So I was churning them, man. But I was doing it on 90-day notes, short-term notes, because I was not buying them as a long-term play. I was buying them, fix them, and flip them. And the bank got sold to another bank. They look up and they can call my notes in 90 days. So they called $1.2 million in 90 days, and it crashed me. And so, because I was a speculator, I wasn't an investor. Now, I would have told you I was a real estate investor, but the actual definition of the term investor means longer term horizon, long window. And so if it's, thank God it's Friday, oh God, it's Monday. If I got to move it this calendar year or in the next 2 calendar years to make money on it, then, you're playing the roulette wheel. You're playing Texas Hold'em. That's speculation. You're gambling then. And that's a different thing. It's okay if you want to do some of that, but quit calling it investing, because then it causes you to put too dadgum much money in it because you lose your butt then. And that's where you get scammed, is you're looking for something for nothing quick, a quick turn, double my money fast, because I don't think I can get there long term. So I'm so desperate and so scared, so fearful, so greedy that I got to get it right now. And that's what I was doing. And it worked. I got $1 million worth of stuff, but I didn't keep it because I built a house of cards. I buy a mutual fund, set it and forget it. I don't even know what the market has done this year. I don't keep up with it. Because I'm not betting on this week. I'm saying, okay, look at what the stock market has done since 1980, since 1990, since 2012. Look at what I would have made if I'd have put $10,000, what it would have made. And that's how I'm playing it, is the long haul, the long play. I never bought single stocks ever. The only dumb thing I did is I bought gold one time. This buddy of mine, again, these buddies in my 20s, he was making money, and he had this gold guy that we could buy options on gold, which we don't even buying the gold, just buying the right to buy the gold. And he said he put in $5,000, and if it goes up, the option goes from $5K to $50K, 10x my money. 14 times in a row, this guy had hit. Wow. And you put it in, and I'm like, he had predicted, and he said, okay, we need to go in right now and put 5,000. I dropped $5,000 in there. 15th time he didn't hit. It's all or nothing. So I lost the whole 5,000. Uber high risk situation. It's super crazy. It was just gambling. I mean, it's just gambling. So if I'm in a mutual fund, I'm in 90 to 200 different stocks, and it's stuff that you drive by every day. It's McDonald's or Home Depot or Dell Computer or Apple. In those 90 to 200, is there some percentage of that problem going on? Yeah, there is. In general, those 90 to 200 companies, I'm spread out wide enough, diversified. I'm spread out enough that I'm catching all the good, and it's more than offsetting the falsehood. As Home Depot makes more money, then I'm participating. As whoever, Apple makes more money than I'm participating because I'm one of the owners of the company, tiny little bit when I own, in that 90 to 200 stocks. So that's how I don't buy single stocks, mainly because they're higher risk and much more volatile, and you're much more prey to what if that was the company that was screwing around? Then boom, you bet the whole dadgum farm on that one horse race, and that guy fell out. No, we're not doing that. So I don't like that much risk. So I like the diversification of mutual funds. That's where all my retirement is. It's what we recommend, what we teach. So I only do two kinds of investing. I buy real estate that I pay cash for, and I buy mutual funds. But yeah, real estate makes more. If it's good income producing real estate, you'll make more on it than you will in mutual funds. Mutual funds average 10, 12%. Real estate, you ought to make 17 to 20, including the tax benefits, the appreciation is going up in value, and the cash flow. Those three things do it. The problem with real estate is it's a pain in the butt. The roof leaks, whether it's commercial office building, whether it's a house, doesn't matter. And I've got a lot of both, but there's a tenant that doesn't pay or does pay, or it's empty and I can't get a tenant. Even if you hired management, my son-in-law runs all the Ramsey real estate stuff, and I grew up in real estate, so I love working with him on it. But he handles the day-to-day. I don't screw with all that today, but it's a pain. So this idea that I hear this stuff on social media stuff, it's real estate's passive income. Bull crap. Nothing passive about it. Your butt's active. You're right in the middle of it, or you're getting screwed, one of the two. Mutual funds, a little more risk because you're in there with all these companies. There could be something going on. Even if you're in 90 to 200 and limited the risk by spreading it out, you still got more risk than you would in a T-bill, but you're going to make a little more. Yeah, you want a little more hassle? Go in real estate. You're going to make a little more. So you don't want to be, I try to just say it's a risk-return ratio. If I'm going to take some risk and have some hassle, I want some extra money for that. I got my real estate license 3 weeks after I turned 18 years old in 1978. And the first house I sold was to a buddy of mine from high school, which means he wasn't smart because he let me sell him a house. Anyway, I sold him that house for $42,500. That house today would be probably $800. And if you bought a house 4 years ago, you've gotten in Nashville, you made serious money on it in 4 years in terms of value increase. But yeah, the nickel dime expenses, the messing with the repairs. Crap, the more stuff you own, the more repairmen you have to know. It doesn't matter whether it's what it is, whether it's got a motor in it or it's cars or houses or boats or all this stuff. Something's always freaking breaking. There's always something screwed up. And it does get the feeling of just the hassle and the aggravation. There's no simplicity to it at all. Your life gets more complicated. So be careful what you wish for. Exactly. It's a rainy day fund. It's not I want a bass boat. It's a rainy day fund. It's not I need a new couch. It's a rainy day fund. You don't touch that. If you're going to buy something else, you save up and pay for it. Baby step 4 is invest 15% of your income. When you don't have any payments except a house payment, you can save 15% of your income. And the average household income in America right now is $72,000 a year. If you save 15% of $72,000 from 30 to 65, you're going to have about $5 million. So if I'm like 5x wrong, you're still a millionaire. You really can't screw this up. It's like, but you can screw it up because you live in America and you can get a $1,200 car payment for a freaking car you can't afford to impress people at a stoplight who don't even care about you.